Good afternoon, everyone, and welcome to our webinar. It's 4 minutes after 3 by my computer clock here, so I think we should get started. We have a few more people that are going to join us along the way, but I think we should start in the interest of time, so thank you for joining us. My name is Andy Paprava. I'm the Senior Advisor to Banking Book Analytics, and with me today we have Sohail Farouk, who is the Chief Executive Officer of Banking Book Analytics, and we'll do a quick housekeeping update in a moment here, but just by way of introduction, some of you may know me by my previous engagement as CEO of the Deposit Insurance Corporation here in Ontario, and Sohail, of course, is the Sohail is the CEO of Banking Book Analytics and has a long background in that business. So I'll ask him to introduce himself now. Go ahead, Sohail.
Hello, everyone. Good afternoon. Depends where you're located. My name is Sohail Farouk. I'm CEO of Banking Book Analytics. I have over 20 years experience in credit risk analytics, developing rating models and associated capitalization measures. I've also been involved in the validation and stress testing of credit risk models. Prior to Banking Book Analytics, I was leading a small boutique consultancy firm here in Toronto. My experience before that has been with big consulting firms. So it's really great to be here with everyone today, and we look forward to a very fruitious discussion. Thank you.
Thanks, Sohail. So just a couple of housekeeping announcements. First off, we're going to leave the microphones open. So if you have any background noise or you want to chat amongst yourselves, if you're in a group, you just mute your own microphone so that we can have people listen in. And so if you have any questions, feel free to jump in either on the microphone, or if you feel more comfortable sending us a message via the chat on the right-hand side of the screen that you have in front of you. One of our participants does not seem to be hearing us very well. So Brian, if that's you, you could try and call in or try and dial in again on the web and see if that makes it work better. We'll stand by. If you can't get in, let us know. A couple of other things. We're going to stop at every now and then, ask any questions, see if you have any questions. So feel free to jump in, or if you have a concern or whatever, just jump in, please do. You should have received a few minutes ago a copy of the presentation. Apologies for the late arrival of that. We had a couple of other things that we wanted to add to the agenda today, and also for the slides. We aim to finish in about an hour or so to respect your time, so hopefully we'll get through all the materials. And of course, this session will be recorded and will be available on our YouTube Banking Book Analytics channel following the link that you see in front of you there. So hopefully you have that information as well in the copy that we sent you. Okay, so with that, let's get started. Sohail's given you a very brief overview of the consultancy on predictive analytics, but back to you, Sohail, for a bit more information about Banking Books, just so everyone knows what you're up to.
Certainly. Banking Book Analytics develops enterprise applications for risk and capital forecasting. What sets us apart from the rest of the peers is that we develop these applications on a customized basis. So our approach here is really looking at the user requirements, developing a user acceptance criteria, and then creating an application that meets your needs. There is no black box. All our approaches are auditable, and we make certain that we get a buy-in from our clients. Our delivery approach is based on subscription-based licensing, which makes our applications very affordable. Thank you.
Thanks, Sohail. So what we're going to cover today a little bit and have a conversation with you on is the following items. Talking a little bit about strategy, and really talking about how we try to optimize strategy versus risk. And I think that's going to be the fundamental discussion point that we have. Sohail's going to walk us through a case study in terms of risk appetite and as part of the strategy enabling process. We're also going to talk a little bit about risk appetite and ICAAP. And then we have a couple of appendices that we thought we would share with you as well as in terms of information. So that's sort of what we want to cover in the next hour or so. So let's talk a little bit about crafting strategy. And, in terms of what the strategic planning challenges are, and I think we all can share some of these thoughts about how do we craft a business strategy to make sure that we take advantage of the risk associated with the business that we're in, and making sure that we utilize our capital most efficiently and effectively. So one of the big things that in Canadian land is going on around the country and around the world actually is, how do you manage the growth and the inherent risk associated with the growth of the loan book or the other parts of the business that are growing quickly, and how do you measure that impact on risk and on capital, and what's the expected return on that? Because I think a lot of organizations, credit unions in particular, have noticed that while they're growing a lot, the return may not be associated. The return associated with that growth may not be what they're looking for or expecting. And then the whole issue around making sure that all the risks associated with the current operations and potential future operations are identified, properly reviewed, and then mitigated to the extent possible. Another big challenge related to strategy is, who are we communicating with, and how do we communicate those growth plans, and how do you do that? So there's obviously different information needs of the various stakeholders. Clearly, senior management has a set of information needs both internally and externally. The board of directors, which is ultimately accountable and responsible for the strategy, and of course the ever-present regulators, which are always breathing down your necks trying to find out what you're doing and how you're doing it so they can avoid any surprises that they don't like to see. And then finally, in this whole discussion around strategy is what are the enablers or strategic levers that can be applied to implement the growth strategy, and how do they interact with all the various pieces? We all know that the regulators and all other parties expect to have policies and guidelines in place, and that's been a big push of the regulatory regimes around the world, not just in Canada and in provinces. And then, making sure that they've been approved by the board of directors and the compliance is somehow assured. And finally, the how, I think, is one of the issues that we're dealing with, and we'll talk about today, is how do you make sure that the systems that are in place are adequately designed and functioning, properly functioning, to make sure there's checks and balances in place to make sure that everything is working as it should. So these are some of the challenges I think we're all facing in my work with credit unions and others, and even supervisory agencies that I consult with. Some of these questions keep coming up time and time again. So the next slide, we'll talk a little bit about the traditional strategic planning flowchart. So essentially, this is what normally you would expect to see in a credit union environment. You'd have at the top end the corporate position. Where are the opportunities for the credit union going forward? What's happening around us, the environmental scan, the competitive landscape, what are the other credit unions doing, what are the other banks doing? How do you assess those opportunities and the feasibility of making sure that they actually get put in place? Then you take that discussion piece and you shift over to the business lines. And the business lines then say, okay, so how do we make this happen? And what competencies do we need? What products do we need? What market should we be serving? Who should be our members if they're not the members we want? And from that perspective comes all the issues around, risk. How are we doing with all these risk elements that are associated with the business lines? At the other end of the scale, you have the finance, and the finance people are always worried about making sure that the money is used, the capital is used properly, make sure we have enough capital, make sure we're making the best use of our funds. And then, of course, communicating that to all the stakeholders. And all that ends up in the middle there under financial performance. How does this all make sense at the end of the day? So then we go from there to, I think, the next sort of visualization of how you balance these things off. So I'm going to ask Soheil to talk a little bit about this optimization curve, also known as the efficient frontier curve, to talk a little bit about how you interact between risk and capital. So go ahead, Soheil.
Yes. So I think if you look at strategy in a traditional sense and look at the role that risk plays within that traditional sense, um, the role of risk is based on a hard stop. So that essentially curbs the role of risk to become a partner of the business. And with that as the background knowledge, the clear message that strategy wants to send is that of the growth. Now, the growth in its dimensions without risk and capital often becomes a meaningless notion because the growth could be in the loan book, but what impact would that loan addition have on the overall portfolio? Is it going to make the portfolio more diverse, or is it going to make the portfolio more concentrated towards a certain industry or towards a certain geographic region? So all these questions need to be answered. So within the traditional setup, we what we do not have is the challenge to the strategy. And the challenge to the strategy comes from looking at it from an optimization perspective. When we look at the optimization curve, we look at how and where we are placed relative to the competition. So in this particular case, we've actually sort of coined the term optimization curve to look at where the industry or the peers are. Now that of course is a function of looking at the market data and being able to derive the efficient frontier. But having said that, where do we want to go is really an important question. Are we planning to reduce the risk, or are we planning to increase the returns? Or are we really planning to increase the riskiness at the same level of risk profile that where we are at? So these are some of the questions that need to be addressed within the context of the optimization. And to be able to answer these questions, we need to be able to determine what framework is going to help us um, accomplish that outcome.
So Soheil, maybe you could just comment a little bit about how this curve is formulated and what the slope of the curve means for credit unions.
Yes. Yes. So the optimization curve essentially implies that what is the minimum acceptable return from a stakeholder's perspective is. Now, as you may know, that for every additional return that credit unions would accept, there is an additional or incremental unit of risk that would come with it. So, looking at this data from a market perspective, of course, we do not have the luxury of looking at the credit union's data, which is not publicly available. Our studies have been limited to the available data from the banks, the Canadian financial institutions, which are publicly traded. So, so this curve can also be looked at as an indifference curve, where the stakeholders find that their returns are considered to be maximized at a given risk profile.
Thanks, Soheil. That's very helpful. And so part of our challenge, of course, in the credit in the world is that the information that might be helpful to do that analysis may or may not be available, or if it's available, it's on an aggregate basis, which is somewhat challenging. Thank you. Maybe we should stop there, see if there's any questions. The mics are open, so if you have any questions, please jump in now, and or we can move on and we can entertain questions as we go along. Okay, so let's move on then, Soheil, and we'll look at the next slide.
Exactly. So I think the idea that we would like to optimize the strategy by incorporating the elements of risk and return is extremely important. Now, the key message that comes out of this idea is that uh, who are the key stakeholders and what their expectations are. Within the credit union space, we have, of course, the member-based equity and the role of the members. But over and above, we have a regulatory requirement that is assigned to the credit unions by regulators such as AICO and other provincial regulators. Um, and then outside of the external stakeholders, who are the internal stakeholders to the process, and what is the mandate that they have been assigned? So external stakeholders are, of course, looking at maximizing their return at a given risk profile, but the internal stakeholders would like to understand that what risks are mandated to them and how they can accept those risks. So within that context, the important part is what is the risk acceptance criteria. um, so the risk acceptance criteria, of course, is a function of understanding and identifying the risks, which are at an inherent level, and what kind of mitigants are there. And then, of course, creating measures and the relevant metrics to be able to determine what the risks are. So, in some cases, there are, of course, risks which are not capitalized, but they're managed. And within the spectrum of managed risks, strategic risk becomes extremely important. So this is, of course, an inevitable outcome of doing business. Um, so we would like to understand what is the risk profile of a particular institution. Within that risk profile, what kind of returns are expected by the stakeholders? And similarly, in a very short-term sense, what kind of tactical opportunities are out there, and how um, they can be capitalized, and the business can be expanded using those tactical opportunities. And finally, what are the idiosyncratic risks, which are essentially risks that are inherent and are undiversifiable, and how those idiosyncratic risks can be diversified or can be hedged, or even can be transferred. So this is something that the strategy developers need to know and understand on an upfront basis, so that they can develop a strategy that addresses not just the concerns raised by the stakeholders, but also the internal stakeholders' concerns.
Great. Any questions on that or any comments from the group? Okay, well, why don't we move on to the case study, Sahil?
Okay, thanks, Andy. So here's a live case study which we undertook. The challenge there was that the client would want to essentially grow their loan book, and their view was at two levels. The first was really looking at the pipeline and expanding the credit funnel so that there is more processing of credit. The second was also looking at the dropouts, and trying to understand whether or not these dropouts were type 2s or type 1s. So in other words, the client wanted to understand whether or not the dropouts which weren't able to get the credit were performing credits, but the internal process failed in terms of the delivery or assignment of the credit or disbursement of the credit. So with these two as ingoing requirements by the client, um, we we set aside three requirements. The first was really expanding the credit funnel. So in terms of credit expansion of the credit funnel, what was required was to understand the risk appetite and delivering the message in how do we expand the risk appetite. The second was the enhancement of capabilities at the underwriting level, and alignment of the processes associated at the underwriting. So, for example, the process that could be attributed to automated approval versus an escalation of the approval versus an involvement of the senior management towards the approval. So, these were the three levers which were identified, with the net outcome of understanding that what would be the delta here, or what would be the change associated with the growth. Now, this change looked at in its isolation would have little or no meaning, because creating a message for the stakeholders was very important. Is this growth limited only to increase in the size of the loan book, Or is this also associated with a risk adjusted return attributed to each risk unit that the organization takes? So that implied that expanding the risk appetite, but also resetting it at the organizational level. And not just resetting it, but also communicating it to the business units and developing a risk appetite statement at each BU level or at the business line level. And the notion that once the risk appetite is applied as a strategic lever became extremely important. And in the end, of course, with some of the recommendations that we discussed, i.e., alignment of the process from automated to senior management's monitoring, looking at the type 2 errors and minimizing those, resulted in, of course, expanding the risk appetite and accepting the risk at a given risk profile.
So here, maybe you could just comment on this case study where they ended up with respect to that risk optimization curve that we talked about earlier. How did this impact that curve or that discussion?
Right. So let me just go back to the risk optimization curve. So the challenge that the organization faced was increasing the risk at a given risk appetite level. So essentially, they wanted to journey from point A to point C. And this basically meant that, accepting more and more risk and yet increasing the return associated with the risk that they take. So again, the question that how every additional unit of risk would have an impact on the loan book becomes extremely important. Whether or not it provides for the diversification, which results in, of course, the enhanced returns, becomes important too. And management of this entire process was the second important dimension of this project, where we looked at mapping the incoming credits and guiding it through the process from an automated all the way to a manual underwriting.
So if one was looking at a portfolio, say, of mortgage loans as an example, how would that figure into this risk minimization and risk optimization curve? So you'd have to go through the data and look at the kinds of loans that you're making now, the credit union's making now, and ensuring that the funnel got larger and the acceptance rate got larger, taking on some more risk, but also making sure that the risk is mitigated to the extent that it was increasing the return on that portfolio. Is that a fair summary of how that would work?
Absolutely. So I think credit funnel and removing the bottlenecks from the credit funnel, and then of course looking at acceptance levels from a risk perspective and the associated returns.
So in other words, changing that, as you see on that curve now, changing the slope of that curve to be a little higher so that the return would offset the increased risk. Is that a fair comment?
Absolutely.
Thank you. I'll stop again. Any questions from the group on the call? Anybody has any other points or questions about how this is coming together? Oh, okay. So let's carry on then.
So, Andy, if you allow me, so I think what we are trying to accomplish here is we are looking at strategy as an optimization challenge, and then we're looking at the building blocks of that optimization curve. The building blocks that we've identified are, of course, the risk at a given risk profile and the acceptance of the return based on that risk profile. But with those two as the important building blocks, the question then becomes, how do we parameterize these building blocks, or what are the inputs to these building blocks? And what kind of framework would allow us to actually undertake this growth challenge, which is based off of an optimization functionality? So increasingly, the organizations are relying on risk appetite as a strategy implementation lever. This is becoming a part of the best practice from not just from the implementation of strategy, but also from the point of view of getting the buy-in from the stakeholders. So risk appetite, of course, is not just at the top level it gets drilled down at the business line level. So, in other words, it is really a great balanced scorecard type of tool which can be used also to assess the performance of the business units. And finally, what is the impact and how the implementation can be undertaken? We looked at different studies and we identified that, of course, the impact is huge, but there are indeed challenges with regards to implementation of risk appetite. And the challenges, of course, emerge from identifying the stakeholders and converging on their needs and assigning some assessment. So, and not just limited to that, but also putting aside flexible limits. So, in other words, the risk becomes from a potential hinderer to a partner of the business. And similarly, going down this table, we look at the strategic planning and incorporation of strategic planning and risk appetite, and then looking at some of the challenges that can emerge by an undiversified portfolio, where our focus is purely on creating returns which could sometimes be uh, um, outside of the optimization curve. And now, these event risks, of course, need to be measured. One needs to have a better understanding of the concentrations and how the concentrations are viewed. Are they viewed purely based on a default, or are they also viewed based on the adversarial movement of the credit or the rating of the obligor? So those are some of the elements that can allow us to develop soft limits to risk appetite, and then underneath that, develop the underwriting tools and the underwriting criteria.
So, Sohail, allow me to ask another question to drill down a little bit on this whole area. So, when you say that the risk appetite is typically partially articulated, in other words, there's a broad statement about risk appetite. Is it fair to say that one of the challenges is to identify the actual limits, the actual specific metrics that need to be used to identify what that means all the way through the organization? It's been my experience that credit unions in particular, and I know credit unions quite well, have generally spoken to a high level of risk appetite within a certain range, but the actual specific limits sometimes are a bit of a challenge to articulate. Is that what you're talking about here?
Yes, so I think at the base of it is really understanding of the risk profile. We when we look at Basel II as a standard framework document, Basel looks at the capital at a level of 99.9% confidence interval. That essentially implies that there is a chance of one event taking place out of 10,000 events. That being said, one adverse event taking place out of 10,000 events, so in terms of the frequency of the events. But that being said, what is the risk profile of credit unions and how do they approach it is really an internal study that needs to be undertaken. There are, of course, simpler ways to look at the risk profile. And once we have the risk profile in place, embedded across the organization, then, of course, we can look at the limits and we can look at the associated returns based on those limits. Um, the challenge with credit unions, unlike banks, is that they're not externally rated more often than the banks. And that implies that the internal ratings and internal understanding of risk profile becomes not just a subjective exercise, but also becomes extremely important, from that perspective.
Great, thank you. Any questions from anyone else? Any different points of view, perhaps? Okay, I don't see any more, so let's carry on then, Sohail.
Okay, so far we have talked about strategy, what are the inputs to the strategy, and what are the strategy delivery levers that the organizations can potentially utilize. But now, what becomes important is really understanding of what are the inputs to those delivery levers from a strategic perspective. So here what we've done is we've looked at the ICAAP principles and we tried to map them with the risk function. So that risk function can actually up its game to become a business partner. And in doing so, what are the ICAAP principles that can actually tie down the risk function, and then in a second order, how it can then partner with the businesses. Now, as you may know, that there is an important requirement which is based on the sound capital assessment. And risk, of course, looks at the capital assessment, but the view of the risk from for capital assessment is essentially based at times on a rule of thumb. It could be 8% capital relative to the risk-weighted assets, or 10%, and so forth. And then there could be some regulatory measures that can actually exacerbate the notion of the rule of thumb, and then which can distort an understanding of the capital in reality. So it is important to look behind the veneer and understand that what is the actual capital that is available to us, and what is the risk adjusted capital. And all of that can really be done once we look at the capital assessment. And then, of course, the comprehensive assessment of the risks. Now, this journey begins with what is called the ERM in credit union space, essentially identification of the risks and then creating the mitigants, and then identifying whether these risks can be managed or need capitalization. So, a good starting point would be really creating a taxonomy of risks and understanding that what activities are really generating these risks from a credit union's perspective, and what are the inherent what are the mitigants to these inherent risks. And then, of course, we're looking at the monitoring and reporting. So, on an ongoing basis, how are these risks monitored? What is the risk measurement metric that is in place? And how often they're reported? And of course, as the risks get more and more severe, their reporting requires more frequency. And then clubbing it all with the internal control. Now, of course, internal control has been a very, very strong field at credit unions. So integrating it with the internal controls is shouldn't really be a huge challenge. But challenge would become where internal controls um, could disrupt the implementation of the strategy. So I think that needs to be managed well on an upfront basis. And finally, the understanding that what information goes to the board and other stakeholders, and what kind of oversight the board and stakeholders can provide with regards to the information. Mapping it all to the building blocks of the risk would allow us to create at least one dimension of the inputs into the risk appetite. And that input is coming off of the capitalization framework.
Well, thank you. Questions, comments before we move on? Okay, I don't see any, so let's carry on.
So, drilling this concept further, and really expanding a bit more on the risk appetite, and what framework can be used to parameterize the risk appetite, it becomes extremely important. So, as we said, the starting point is the notion of growth. And then, of course, underneath that is the notion of the activities of the credit union. And once we have those captured, then we start looking at what activities are generating the types of risks that the credit union's involved in. So, a common risk, of course, would from a credit lending institution perspective, would of course be the credit risk. So, how is the credit risk being measured? Is this measured using an ordinal framework, or is this measured using a more qualitative type of framework? And whether or not a risk metric, which is commonly used, be applied to the credit framework, credit measurement framework. So most of the credit unions have to be able to develop internal models, and those internal models can then be used from the perspective of assigning a certain credit risk metric, which is from a frequency perspective, which is called the probability of default, from a severity perspective, that is known as the loss given default. And once we have these two parameters in place, we can then develop an economic capital from a credit risk perspective. Similarly, the activities that can generate the market risk are investments, are also related to the asset liability management. So looking at the interest rate risk and the liquidity risk, and then of course projecting the sources and uses of the capital would allow us to determine that whether or not our funds are adequate or we have shortage of funds going forward. And then stressing it all would allow us to determine the economic capital for market risk. The typical measures or metrics there are value at risk, essentially, and there are different frameworks and methodologies that can be used to determine the value at risk. Some of those could be Monte Carlos or variance covariance framework, principal component analysis, and so forth. And then operational risk is becoming increasingly important, not just because there are internal challenges with regards to the operations, but because the external risks, such as cyber risk, are getting increasing prominence. Recent surveys have indicated that non-financial risks could potentially become the largest or one of the biggest threat to the financial institutions, which of course includes the climate risk and the cyber risk and so forth. So understanding the operational risks, both from an internal perspective as well as from an external perspective, becomes very important. And then, as we've talked about the models that we are going to apply to come up with the capitalization measure, it then also becomes important to understand the risks associated with the models and how do we mitigate those risks. So that is really clubbed all under the operational risk. And then finally, we talked about the risks which are, say, idiosyncratic, or risks which are strategic, or the business risks or tactical risks. So there could potentially be either a management framework to manage those risks, or we can develop an economic capital framework. All of that can be aggregated and can be diversification benefits can be gleaned. But the point that we are trying to make is that this framework provides convergence of strategy with internal capital. This framework provides projected financials and converging them with the risk appetite. So essentially, we can not just look at traditional measure, but we can enhance the traditional measure using an optimization framework. And all of this can be mapped using forecasting, so financial forecasting as well as risk-related forecasting, and then the associated capital plans for future. And then, of course, a risk dashboard or a risk appetite dashboard can be developed.
So in the end, Sohail, when you do all this excellent work and you come up with a capital plan and a risk dashboard, how comfortable should management be and the board perhaps be that it's disciplined enough to have come to the right place? And come back to this discussion around optimization of risk and opportunity in terms of growth and capital and all the things that you just talked about.
Right. That's a very good point, Andy. And in our experience, what we've seen is that the comfort level is really a function of the data and the accuracy of the data. And of course, the second important element to the comfort level is the modeling methodologies. So from a historical perspective, a good starting point would be developing frameworks such as earnings at risk and simulating the earnings to be able to come up with a measure which can help credit unions at least mitigate the earning shocks. So that's a great starting point. And as more and more data becomes available, then enhanced capital plans can be enhanced and modeling sophistication can be enhanced. So those are, it's of course a journey. And the comfort level, if you allow me, is also a function of the validation and the backtesting of the models, which becomes extremely important as more and more models become available and are used to come up with such metrics.
That's exactly what I was going to ask about. So how, yeah, you have to validate the models to make sure that the outcomes that you're getting, the results that you're getting make sense. And so given what I think is perhaps a paucity of data sometimes of credit unions, how do you build models that can validate these things without having to recreate a data set that you may or may not have?
That's a great point. So I think there are a few building blocks which credit unions already have. So at a baseline level, our understanding is that the credit unions are using the beacon scores from a retail book perspective, and also from a residential mortgage perspective, HELOCs and so forth. And then at the SME, there is some evidence that the beacon scores are used as well. Similarly, when you sort of go further up in the value chain and start looking at the commercial and the mid market and the corporate books, there are some internal metrics that the credit unions have. And these metrics can, of course, be, as I said earlier, can, of course, be sort of quantified and then mapped or calibrated to a certain probability of default. There is also a possibility of using some benchmarks. These benchmarks are externally available, and they're also very powerful tools in terms of developing models. And of course, the third and the most important possibility is tapping into the internal expertise of the folks at credit unions and the management, and using their buy-in from the perspective of, say, the credit worthiness and discriminating good borrowers from the bad borrowers, and creating those finer metrics using the expert judgment. So there are 3 or 4 ways that can really be used sort of at a composite level to come up with some of these metrics.
Great, thank you. Any questions on this area from anyone on the phone? I don't see any more, so let's carry on then. Thank you.
Perfect.
This is my favorite. Next one's my favorite slide.
Okay. So as we said earlier, that understanding the risk profile helps creating a robust capital management framework. So at a given risk profile, what is it that we're trying to accomplish? Let's for a moment think that we do not have any given risk profile at a certain credit union. And then what would be the returns and what would be the riskiness of a credit union look like? So in the absence of risk profile, the key metric that the credit unions can use is purely an accounting metric. Now, accounting metrics are essentially based off of the historic data. There is limited involvement of the external data, with the exception of, say, IFRS 9. So creating and applying the historic accounting metric and understanding whether we were generating a certain return, of course, creates the problem of the traditional strategic metric, and then remove the important elements or the building blocks such as risk and capital. So, of course, mapping credit union's risk profile to, say, an external rating would be very, very important. And once we have that understanding, then we can go from understanding what are the available financial resources and what is the economic capital which is required based off of that risk profile. And hence, we're looking at a certain confidence interval. And once we have that, then the discussion about strategy, the discussion about the growth, and discussion about the capital deficit or surplus becomes more and more relevant.
So if I could just bear on with me for a second, just to understand this. So if you feel that your available financial resources versus your economic capital are under where they need to be, below the line, if I could say it that. So therefore, you have to do a number of things. You have to raise more capital somehow, either earn it or raise it from members.
Right.
Find a way to reduce the risk in the portfolios in the business, and then divest in the highly regulatory capital business. So, for example, commercial loans might be a good example. You might want to divest of some commercial loans, or not necessarily do any more of them until um, the balance returns. So how do you know when you're on that line in the middle, where you're in that sweet spot, I'll call it? How do you know that?
Right. So, of course, the economic capital and available financial resources. Let's just say the available financial resources can be termed broadly as the equity that is available. And then, as we said, the economic capital is really the economic or the capital that is based on a certain confidence interval to credit union, which is a function of the risk profile. Now, how do we know that we are at that sweet spot is really an outcome of the exercise that we earlier described, which looked at the credit union's credit book, which can potentially be applied using a top-down approach to make things more efficient and to make things a little easier. And then within that context, there are two important metrics that we're looking at. The first metric that we're looking at is the expected loss. And the second metric that we're looking at is the unexpected loss. So unexpected loss essentially implies that the loss for which you need to hold certain capital. And that loss essentially is really an outcome of, say, any stress-related event for which the organization did not have provided for. So, given the limited information that we have, the unexpected loss is then multiplied by a certain K multiplier. As we said, that is really an outcome of the confidence interval, which could be 8 times or so forth, which would allow us to determine that this is the undiversified credit risk related capital. And then, of course, there could be more sophistication added to this model by including the diversification aspects, and then identifying that this is the capital, economic capital that we have available. Now, let's look at the equity that is available with us. Are we really above the line or below the line? And that would allow the credit unions to engage themselves in discussions relating to what is the area of growth, where the capital is being consumed at a higher rate and little return is being generated, where the capital is being consumed at a lower rate, yet higher return is being generated, and so forth. So these are some of the important predictive analytics or the insights that modeling can generate for credit unions.
Great, thank you. Very comprehensive. Any questions from the group at all? No? Okay, let's move on then.
Thank you. Okay, so as we said earlier, that there are, of course, several applications. The first and foremost application that we came up was relating to the strategy. But and we just talked about the solvency and the sustainability from a business perspective. But the other important application is really an understanding and having a conversation with the regulator. Regulators are, of course, very interested in increasing the capitalization level. We've done several studies in terms of understanding that what is the most optimum capital level. And that was done for the Canadian banking institutions, the large banking institutions. And one of the things that we came back was that the fact that the ability to assign a lower risk weight is an extremely important factor from the capitalization perspective. So the problem or the challenge that credit unions have is that there could be a flat risk weight assignment from a regulator's perspective. But how do we challenge that? So the easiest way to challenge that would be really to look at the economic capital and its application, and understanding that what is really the right capital measure for credit unions, and whether or not there is surplus that exists or a buffer that can be used. And that could open doors from a regulatory dialogues perspective for credit unions, which then essentially implies that you can use or distribute your excess capital, or leverage your excess capital by acquiring those assets which produce the return above the market. And then, of course, the application number 3 is a limit setting. So instead of having a hard stop, there could be several soft stops, which could be a function of the risk adjusted return. So again, very important application. There could also be risk-based limit setting. So in other words, looking at the criteria from risk metric perspective, limits can be established. There could also be refined view of the concentration risk as opposed to using a rule of thumb based capitalization. And then we talked about the portfolio optimization. The whole question of optimization becomes relevant here. And finally, the economic profit and how that economic profit can be measured and forecast. And then, of course, once we have this entire analytic in place, then we can assign the value management based metric to the membership. So looking at the membership and identifying that which members are providing the highest return, technically the highest return to credit unions, and what kind of process that these members should be run through also becomes extremely important. So process refinements from a membership perspective, this can open doors from creating new products in wealth management. This can open doors in creating more and more robust relationship management, and also help create uh, the performance metric for the RMs and other sort of relevant business line managers.
So here's a challenge. Most regulatory structures in Canada for credit unions don't allow for internal modeling. They basically provide each credit union with a set of rules that said this is the capital you must hold against this type of asset or this risk. And when you get anywhere close to the minimum, everybody gets excited. The credit union regulators, the credit union board, management, everybody gets excited. How does this model or this approach help credit unions manage that relationship between what the regulators are looking for and what the members are looking for, and become a bit more, I guess, more sophisticated in understanding the risks and understanding how the capital is better utilized?
So
That's
Andy,
it's a loaded question.
it is. But I mean, you're the expert on the regulatory side. So, what are your thoughts? Are the regulators in Canada looking at perhaps creating the same level of regulations as OSFI has for credit unions?
Not anytime soon. Maybe for the larger, more sophisticated credit unions, there's an opportunity to have that conversation with the ICO and perhaps FICOM and a few others. But I think generally speaking, the credit union regulators in the provincial jurisdictions and our colleagues on the call here on the webinar can correct me if I'm wrong, are generally risk adverse, and they're going to be looking for minimums to be associated with that. Again, that's minimums. I think really the point I'm asking here is whether or not there's an opportunity here to do two things. One is to make sure that the models that are being used are more skewed or more what's the word I'm looking for? More attractive from the sense of being able to understand where the profitability is coming from and where the risk is situated in the book in the various types of businesses, as well as trying to figure out whether or not they truly are, in terms of an ICAAP scenario for the regulators, whether they truly are significantly or slightly or over capitalized in certain areas.
Yes.
Which would then have the conversation around, in terms of strategy, back to strategy for a minute, are we in the right business? Are we going about it the right way? Discussion as opposed to, oh, we have too much capital, not enough capital. I think that's really the benefit of this approach is looking at it from the perspective of strategy and convincing the both the board and the regulators ultimately that the strategy is the right one from a risk perspective.
Yes, yes. There's another application, of course, that is missing here is the capital buffer, which regulators would like to see. Now, in terms of the adequacy of the capital buffer, it becomes extremely important that there is a stress testing that is done. And all of that really is an outcome of the internal capital process. Um, and finally, of course, we are not limiting ourselves just to the capital buffer, but we're also looking at the data that goes in from a raw data perspective. Um, these capitalization measures are only as good as the data is as the available data is, and whether or not this data has been treated for point in time adjustments becomes extremely important too. So going back to your point, Andy, strategy and its application, looking at the business, whether we're in the right business, and then having a conversation with the regulator are two important takeaways, of course.
Thank you, Sohail. So anyway, we're gonna start losing people here shortly. So, is there anything else that you want to wrap up with here? I think there's a few more slides that you just want to maybe run through quickly.
Exactly. So I think we are now at the questions, comments, and conversation stage. So of course, we hope that you found this webinar useful from the point of view of your day-to-day engagements in the business. And if there are any questions, please feel free to share your thoughts with us.
And while people are thinking of any questions they might have, why don't we just carry on and just cover off the other slides that you have in the deck that you've shared with everybody, if that's okay.
Certainly. So of course, we've used several terms here, and we thought it would probably be meaningful to have a certain reference slide relative to those terms. We're always available to address or answer any questions that you may have. And then there are some applications that we have available, which we would be happy to demo for yourselves and at the time of your convenience, of course. And finally, we talked a little bit about the applications and the suite of applications that we've developed. We also have on our call with us our Chief Technology Officer, Mark Gibbs. Mark, would you like to say a brief hello to the participants on the webinar?
Good afternoon, everybody. As Hal said, I've just joined Banking Book Analytics. It's nice to be here and to hear so much about what we've got so far. Thanks.
Great. Well, over to you, Andy. Thank you.
Oh, thank you, Sohail. So unless there's any other questions, I think we'll wrap it up. It's precisely 4:02, I think, by my watch. If there's any questions at all, feel free to jump in now. And if you have any questions that we didn't, or any areas that we didn't address today, by all means, feel free to send us an email. Happy to answer them. Happy to give you any further information. And of course, if you would like any kind of a, as Sohail indicated, demonstration of some of the areas that we just talked about in terms of details, happy to do that as well. I'm going to also let you know that there's another webinar scheduled. I think it's going to be on December the 3rd at 3 o'clock again Eastern time, and 12 o'clock or noon on Pacific time. So if you're interested and available, we'll be talking about another topic going forward as well. So with that, I see no other questions, Sohail. So I think with that summary, thank everybody for joining us today. Thank you all for your valuable time, and we look forward to seeing you again. In the meantime, please feel free to give us a shout or an email. Thank you, and good afternoon, everyone. Take care.
Thank you. Bye-bye.